ASML is a company that participated in the huge tech boom over the past few years, and over the past 5 years they are up by 161%. If we have a look at the 1-year chart, we can see that they fell from their all-time high of 1021 euros to 605 euros and are currently trading very near their 52-week low. And so today in this video I will show you exactly why investing into ASML will guarantee a great return in the near future. We have to plug in the ticker ASML for ASML. And right away we can see that ASML is a dividend company. They currently pay out a dividend of 0.96%, which is below average, and gives us a dividend payout of $6.56, with a trailing free cash flow payout ratio of 36.21%. Now, before we move to the 9-pillar analysis, I just want to explain why ASML is such an indestructible company. They are the only chip machine creator with machines that can create the tiniest of nano chips, which are bought and used by companies such as Taiwanese Semiconductors, Intel, or Nvidia. So they have extreme power in this specific sector, and with the AI boom, they are guaranteed to grow. Now, jumping to the 9-pillar analysis, we can see that ASML gets a rating of 7 out of 9. We can see that ASML would be considered overvalued compared to their earnings, as their 5-year PE ratio is sitting at almost 40, and they would also be considered overvalued compared to their free cash flow, as their price to free cash flow is sitting at 36.21. Now, it makes sense that ASML would be trading at a premium, as they are a premium company, but for me, the PE ratio and the price to free cash flow are still a little bit too expensive. Now, regarding the pillars in the green, we can see that ASML has been growing their revenue at a rate of 18.11% yearly. They have been increasing their free cash flow at a rate of 33.85% yearly and growing their net income at a rate of 25.20% yearly. They also have a 5-year profit margin of almost 50% and decreasing shares outstanding at a rate of about 1.36% every single year. Now, regarding their long-term liabilities, over the 5-year free cash flow negative dividend, this ratio is sitting at 0.21, which means that they can pay off all their long-term liabilities in about a year, which is awesome. And they also have consecutive dividend growth sitting at a rate of 10.78% yearly, which is more than double the average. But now let's calculate ASML's intrinsic value, first using the Grams formula revised. And here we plug in the 5-year earnings estimate at 23.86% yearly and get an intrinsic value of $610.68, which is 10% lower than the current trading price of the company. Now, regarding our discounted cash flow model, here we plug in a free cash flow growth rate into the future of 18.3% and a discount rate at 8.4%, and this gives us an intrinsic value of $392.46, which is much lower than the current trading price. Now, with ASML, we will skip the multiples valuation, as ASML is a one-of-its-kind company, and we will arrive straight to the dividend discount model, where after plugging in a projected growth rate of 7.5% into the future, we get an intrinsic value of $751.68. Then finally arriving to the ultimate valuation, where we average out the three valuation models, we get an intrinsic value of $584.94, which is about 13% lower than the current trading price of the company, and with a margin of safety of 10%, we get an acceptable buy price at $526.45. So the best step to take now is to wait for the company to fall below its intrinsic value and then load up on it, as investing into ASML in the correct time will certainly bring great return. And with that, if you did enjoy the video, make sure to leave a like and subscribe, as it really helps me out.